Hey everybody, it's Ahmed here with Down to Trade. It's Thursday, February 16th, 2023. Sorry I haven't made a video in a while, but I've been sick as a dog for several weeks and I just didn't want you to have to listen to me coughing in the video. But we've been having a great time in the Down to Trade room. Today, I wanted to take a deep dive into a very important aspect of trading, which I think gets overlooked all too often. And I'm talking about recognizing and adjusting your strategy to changes or shifts in the market. We all saw so many traders start off 2022 with a great jump start for the first half of the year or so. And then many of those same traders felt the frustration of running into a wall of losses in the latter half of the year. So, what happened? What changed? And most importantly, what can you do to avoid this in the future? I bring it up because I'm beginning to notice another possible shift occurring right now in the 0 DTE market. We'll discuss it and I'll give you my thoughts on what adjustments we'll be making in the down to trade room. There's a lot to talk about, so let's get down to trading. Before we jump into the market, let's catch up from my last video back at the end of January. Here, we have our daily tab in the down to trade journal, and we're a little more than halfway through February. Up until yesterday, we were in a nice 16-day win streak since January 18th? Now, obviously, not all of these green days were home runs. A couple of them were just barely green, but I still count them toward my win streak as long as they're not red. But yesterday, we did finally bump into a losing day, but we made most of it back just this morning. Looking at our journal tab, we can see all of our trades that we've taken for the year so far. I like looking at all that green. But of the 53 trades we've taken across, 27 days of trading, we have a 76% win rate with an actual average risk reward profile of a little over 2 to 1, meaning our losses are about double what our wins are. But with that win rate of about 75%, this is well within our expected range. And in fact, it's slightly higher than our expected return because we've been able to keep our losses relatively small. Now, we started out this year with $40,491 in the down to trade account. And in the last 6-7 weeks or so, we've made a net profit of about 42.50, give or take, for a net rate of return of about 10.5%. When we jump over to our expected return tab, we can see our actual net return for the year here in orange compared to our expected return in blue. Now, after a minor dip in January, we bounced back and are back above the expected return line. In fact, down here, you'll see that we're right on track for the year so far. Remember, the return that I show you here is not a return of money invested in each individual trade. It's the net profit compared to the beginning balance at the start of the year. Now, looking below, we see that our win rate on a daily basis is 85%, meaning we've closed the day in the green 85% of the time. Now, you notice my risk reward ratio is a little closer to 3 to 1 on a daily basis. And that's because, like I said, we had a couple really small green days when I had to crawl out of a losing day. But again, with an 85% win rate, the expected return is nice and positive. And I have no reason to believe the tide is going to change. Sure, there's going to be shifts in the market, and sure, we'll have to adjust our strategy from time to time throughout the year. But just like we were able to recognize those shifts, which occurred in 22 rather quickly, and thanks to those adjustments we made, we ended up closing out that year with more than 100% rate of return. By the way, a quick little reminder about this tab. You may have noticed that this end of year expected return value here, which says 141%, has dropped from, I believe, 148% at the beginning of the year. Again, this is because it is based on the number of possible trade days left in the year. So when I miss a day of trading, the journal will lower my overall expected return to account for this. I typically only trade 4 days per week. So after accounting for what days I've already missed and what days I will miss in the future, the expected return should settle at around 105, 110% by the end of the year, which is right in line with where we closed out 2022 at 106%. Anyways, enough about the down to trade room. I want to talk about the market because, like I said, I see a possible shift occurring in the market climate right now. And it's probably not what you're thinking. I'm not talking about a shift in the overall global economy, although that is definitely happening. I'm talking today about a shift in 0 DTE strategies on the SPX, which for the down to trade room is our bread and butter. So this is an important topic because it seems most traders don't take these shifts into account enough. Oftentimes, I hear from traders who complain that the strategy they've been using for so long is no longer working. And what I try to teach them are the steps necessary to avoid that pitfall. I'm sure many of you now recognize the shifts in 0 DTE trading, which have occurred in the last couple years. A really good friend of mine would always tell me, every trading strategy works, just not all the time. And this is so true. But why don't more traders make timely adjustments in their strategy as the market climate shifts? Well, in my humble opinion, the secret comes down to a few important steps, which, when deployed effectively across all of your trading strategies, can drastically decrease your chances of becoming another trading statistic. So, what are these steps? First, you have to be able to recognize that a shift is occurring in the market. Then, you have to analyze how this shift is affecting your strategy. Next, you'll need to adjust your strategy effectively to counter the shift. And finally, you'll need to test if your adjustment even worked effectively. And the cycle just continues to repeat, so on and so forth. So let's break this down by looking at some of the shifts we made in 2021 and 2022. Okay, here we're looking at the daily chart for SPX, looking at the years 2021 and into 2022. Now, for most of 2021, we were entering iron condors very often, and you can kind of see why. Look at the true range of all of these candles. They're all relatively small. And combined with the low volatility environment we were in, it was a perfect time to trade with iron condors. But then 2022 happened, and we realized our iron condors weren't working all that well. We noticed we would get stopped out on one of our spreads more often. So we began to adjust our strategy by deploying more directional spreads, and the results were almost immediate. We were back to making money. Then, later in 2022, another shift occurred. During the first half of the year, we were taking positions early on in the day and were letting the majority of those positions expire worthless. Then, about halfway through the year, I began to notice that the market would often drastically reverse in the middle of the day, and I was getting stopped out more often. It didn't really even matter why the shift in the market occurred. All that mattered is that we were able to recognize something was changing and we were able to do something about it. Now, I chose in this case to lower my take profit from 1.5% to 1%. In other words, I tightened my take profit. Now, on the plus side, this increased my win rate, meaning I was profitable more often. I was winning more often. But it also increased my risk reward profile because I was now risking 3% to only make 1%. But with the increased win rate, my expected return remained the same. So the point is, being able to recognize that what has been working is no longer working is probably the most important step in the process. Now, I personally have a system in place to help me recognize these shifts in time. I've talked about this process several times in other videos, but the main idea is this. So at the end of every single day, I take notes on my chart in TradingView, and then I save those notes to the notes section in my trade journal here. TradingView actually gives you the ability to save a link to the chart, and I just paste it into the notes section of my journal as I just showed you. Now, this is that link right here from today. My notes will include any mistakes I made during the day, what I could have done different, what I noticed about market internals, what I did right, what I did wrong, so on. Now, every Friday, I go through each chart from the week and take notes of any big ticket items I noticed throughout the week. Then at the end of the month, I will reread all of the notes from the previous Fridays and see if anything weird is standing out, any anomalies, any patterns that I may notice. Now, this process is exactly how I've been able to avoid unnecessary pitfalls in the market over the last couple years. It is extremely difficult to do if you're not in the habit of journaling your trades and taking notes. That said, I have noticed something creeping up in the market climate lately, and I have just begun adjusting my strategy to this possible change. Now, what I'm noticing lately is that we're seeing a kind of a convergence of market internals in the first 30 to 60 minutes of the day, most notably with the US dollar. Now, I track the DXY, the US dollar, versus the S&P index throughout the day, and as we all know, these two asset classes are typically negatively correlated, meaning as one goes up, the other should be going down. But I've noticed lately they seem to be converging early on in the day, and it's been getting tougher to get a directional signal. So I decided to adjust my strategy by waiting for this convergence to go away before I enter the market. In other words, if I notice the signal is not being clear in a direction, I won't enter a position even if it delays my entry by an hour. Who cares? I'd rather get a late start on a good signal than an early start on a bad signal. So, for instance, this morning, I didn't get into a trade until 46 minutes after the market opened. But as you can see, I waited for the US dollar to act right before I entered my bull put spread. And shortly thereafter, I took profit for my 1% return on the day. Now, you may think, so what? Your shift is that you're waiting for a signal. Who cares? You should always wait for a signal before entering. And you're correct. The adjustment really is mentally or emotionally, and it's twofold. One, I'm now recognizing that the US dollar is behaving differently. And two, I'm adjusting my mindset to one of being more patient with my entry and being okay with entering 30, 60 minutes after market open. Anyways, I'm very interested to see if this shift continues for a while or if it's just a fluke and I'm overreacting. Time will only tell. Look, if you're struggling to adjust your strategy to the market, or perhaps you don't have the time necessary to analyze the market like we do, or if you're just looking for a great community to be a part of, consider joining the Down to Trade Room. I'll leave a link in the description below. Now, if you like any part of this video, let me know by smashing that like button and don't forget to subscribe. As always, I'd love to hear your thoughts and comments below of what content you'd like to see. Well, that's it for me. Take care, everyone. Happy trading.